What's up, guys? I'm Nobody Special, and as we speak, it seems the price of gold is just stuck at $1,800 an ounce. We're going to look in all the traditional metrics that have been used to value gold to see if we can explain why gold is where it is, or maybe gold really just is undervalued. You ready? Hit it. Thank you for joining me. I'm Jack Gamble, and I'm Nobody Special. And if you're like me, you've been sitting here looking at the price of gold being stuck at this $1,800 range, and you've been scratching your head trying to understand why, oh why, the gold price just won't move. So I want to look at some of the historical metrics that have been used to value gold and some of the historical correlations with gold to see if we can explain it. Now, there's other precious metals like silver, platinum, and palladium, and those are monetary metals to a certain extent, but there's also a heavy industrial usage in those metals. So that makes their traditional valuations a little bit more difficult to measure, because while you're looking at the monetary element, you also have to factor in the industrial application. So for the sake of this video, we're going to focus just on gold, because gold is almost exclusively a monetary metal used as a safe haven asset or a hedge against inflation. So here we're looking at a one-year chart in the price of gold. Here we are today, stuck around this $1,800 level. Now you notice we've been trading a little bit sideways with somewhat of a downtrend since that high we put in last August. Last August we were at a high of $2,103.20 an ounce. That was an all-time high closing price for gold. So I want to see what's happened over the course of this year since last August that could possibly explain this decline in the price of gold. Now, by far, the single biggest input in the price of gold is real yields. Now, that's the yield on the U.S. 10-year Treasury bond minus the rate of inflation. Now, looking at the Federal Reserve's website, here's a list of real yields across the whole yield curve. And I want to focus in on this most recent data read on the 10-year note. We're at minus 1.11%. Now, I want to put that into context for you. If you make a loan to the federal government for 10 years, after 1 year of that loan, you take the interest the government has paid you and you subtract the rate of inflation, and your spending power has gone down by 1.11%. So this is a very big deal. Now, I wanted to pull up a chart and go look at the last time real yields were this low, and I ran into one problem. Real yields have never been this low. This is historically the lowest real yields have ever been. So you would think with real yields being the single largest input to gold price that we'd be somewhere around an all-time high, but that's far from it. So to put this in context, I brought up a chart of TIPS. That's 10-year Treasury inflation-protected securities, which is basically real yields. And you can look, here we are today at minus 1.11%. And if you go all the way back, you can see we've never been this low. The closest we've ever come is August 6th, that all-time high in the price of gold. But even then, real yields were only minus 1.08%. So looking at the strongest metric there is for gold price, you can see that we should be at least $300 higher in the price of gold. So the strongest correlation to gold price, real yields, does not justify the price we're at right now. Now, another less used indicator to inform gold prices has been the price of oil, because historically oil has been a pretty good indicator of inflation. Now, this is not a perfect correlation, the price of gold and the price of oil, but there has been a pretty strong correlation historically. So looking here at a one-year chart of the price of oil, here we sit today, $71.66 a barrel. And how does that compare to our all-time high in the price of gold on August 6th? Well, back then we were only $41.95 a barrel. So even using this traditional valuation metric for the price of gold shouldn't just be at least equal to where it was on August 6th. It should be significantly higher than where it was August 6th. Again, oil is not a perfect correlation with the price of gold, but it is one of those factors that informs gold prices. Now, I've been scouring financial press to try to figure out if any of these analysts or market gurus can justify why gold is where it is using any of these traditional valuations. And I did find one data point that has been referenced over and over again as a possible explanation for why gold is not at an all-time high. And that has been the dollar index, or the DXY. Now, the DXY is a measure of the dollar compared to other world currencies. I want to emphasize that the DXY does not measure the value of the dollar in terms of stuff you can buy with the dollar. The Dixie measures the dollar in terms of how many euros you can buy with a dollar or how many pounds. Now, let me just preface by saying how much I hate the Dixie as an indicator when informing gold price. Again, Dixie does not measure how much stuff your dollar buys. The Dixie just measures other currencies. Well, right now the dollar is being beaten like a redheaded stepchild by Jay Powell and his money printer over at the Federal Reserve. Well, the same thing is going on in Europe and in Asia with their currencies. Central banks around the world are in this stupid contest where they're all trying to abuse their currencies the most. And whoever comes to their senses first loses. Now, I want to emphasize, if you measure the dollar's strength against anything but other currencies, you can see this happening. Look at a one-year chart of oil. Look at a one-year chart of natural gas. Look at a one-year chart of corn. Look at a one-year chart of aluminum. Look at a one-year chart of copper. Heck, even lumber, despite that ridiculous spike and the ridiculous overblown sell-off after the spike, if you zoom in, lumber is still a little bit higher than it was even a year ago. So measuring the strength of a dollar against anything, the dollar is weaker than it was a year ago. But for shits and giggles, let's entertain this ridiculous argument and say that the Dixie is a valid input to the price of gold. Well, here's the Dixie today at 92.39. Now, where was the Dixie at on August 6th when gold made its all-time high of $2,100? Virtually identical, 92.79. So even if we entertain all these talking heads in financial press who are trying to justify today's price in gold using the Dixie as an excuse, we should still be at least where we were back in August. So even this most ridiculous argument justifying gold's low price right now does not hold water when held up against even the most moderate of scrutiny. There just is no valid macroeconomic explanation for the price of gold being where it is. So now we've looked at the price of gold against all the historical macroeconomic indicators that inform the price of gold, and we've established that something is wrong. All right? All the traditional metrics to inform gold prices are no longer informing gold prices. So what's wrong? Which one is right? Is the price of gold too low, or should the Dixie be higher? Is the price of gold too low, or should the price of copper, natural gas, oil, aluminum, lumber, should all those things be lower? Is the price of gold too low, or should the yield on tips be higher? Is the price of gold too low, or should real yields be higher? I'm a big proponent of Occam's razor. All right? The simplest explanation is usually the right explanation. And in this case, which is the more simple explanation? That gold is undervalued or everything else is wrong? Again, the most logical conclusion is that gold is undervalued. Now, I want to throw in one little caveat here. There's a growing chorus of people in financial YouTube that is calling for deflation in the near term or the medium term. Now, these are not numbskulls. All right, these are not your weekend warrior YouTubers. These are guys like George Gammon, Stephen Van Meter, Johnny Bravo. These are some very sharp guys with some very informed opinions. Now, I'm not going to get into the mechanics of the case they're making for deflation. But suffice it to say, there are some very intelligent people who are saying there's deflation on the horizon. And that would explain the low gold price right now. Right? If the value of the dollar is expected to increase in the medium term, then that would suggest lower gold prices. That could explain why gold is so low. Now, me personally, I don't subscribe to that theory, or I guess I should say I subscribe to kind of a hybrid of that theory where there could be a deflationary market crash on the horizon followed by an astronomical hyperinflation because the results of the government is always to print more money every time there's an economic calamity. But that is one possible explanation for why gold prices are so low. Now, again, Occam's razor, what is the simplest explanation? I don't think the deflation argument is the simplest explanation. And therefore, it's a little more far-fetched to me. Everything I look at, no matter where I go, it all comes back down to the price of gold is undervalued. gold prices must go higher. I don't know when that's going to happen, but it should happen. Or if it doesn't happen, interest rates will go much higher and the price of everything else will go much lower. Guys, I want to thank you for your time. I really appreciate you coming and checking out this video. If you liked it, please give me a thumbs up, subscribe to my channel, and hit that notification bell. It would really help me out. In the meantime, live small and dream big.